Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, my name is Lidya Ratulangi. I will explain in presentation about my task of accounting management. I will explain 5 points. There are the nature, source, and purpose of management information, cost accounting techniques, budgeting, standard costing, and performance measurement. Okay, we will start with the first point, the nature, source, and purpose of management information. To make a good information, we using a well-known mnemonic. The qualities of good information can be summarized in the word accurate. A for accurate, C for complete, second C for cost beneficial, U for understandable, R for relevant, A for adaptable, T for timely, and E for easy to use. Okay, next, management accounting. Management accounting is the process of identification, measurement, accumulation, analysis, preparation, interpretation, and reporting of information used by management to set targets, plan resource allocation, evaluate investment choices, and monitor or control the operating performance and the orderly conduct of the business. There are differences in purpose and scope compared to financial accounting. The first, for accounting management or management accounting, aimed at internal user, as opposed to financial accounting, which is aimed at external stakeholder. The second, for management accounting, focus on present and future performance, as opposed to financial accounting, which reports past performance. Third, for management accounting, not required by law and not regulated by accounting framework, as opposed to financial accounting, which is a legal requirement and regulated by accounting framework. Fourth, for management accounting, focus on specific areas or activities, as opposed to financial accounting, which provides a holistic view of company's performance. And last, for management accounting, employs non-financial indicator as well financial, while financial accounting use only financial measure. Next, managerial process. The key process which fast management can be divided into planning, decision making, and control. Next, responsibility center. There are cost center, revenue center, profit centers, investment centers. Next, I will explain the second point. The second point is cost accounting techniques. For material, the ordering, receiving, and issuing of materials from inventory must be controlled according to procedures and documented at all stages with forms appropriate to the purpose. The control and procedures are designed to monitor inventory movements so as to minimize discrepancies and loss and theft. There are methods in cost accounting technique. The first, economic order, quantity. Next, labor, absorption costing, contribution, marginal costing, absorption costing, job costing or batch costing, process costing, equivalent units, weight average method versus inverse out method, joint products or byproducts. Okay, next, the third point is budgeting. In budgeting, quantitative plan for the future used to communicate objectives, motivate employees, control activities, and evaluate performance. There are some master budget process. The first, annual frequency, preferable, revised on a regular basis or rolling budget, and based on organization's objectives, expressed in financial, quantitative, and qualitative measures. The operating budget sequence, sales budget, production budget, ending inventory budget, direct materials budget, direct labor budget, factory overhead budget, cost of sales budget, R&D budget, marketing budget, distribution budget, customer service budget, admin budget, and pro forma income statement. The financial budget sequence, capital budget, cash budget, pro forma balance sheet, and pro forma statement of cash flow. On operating budget, these are budgets that quantify the revenue and cost relating to a company's activities at disaggregated level, meaning that there is direct input from department and functional level. On budget, there are expected value, regressive analysis, discounted cash flow techniques, discounting net present value, relevant cash flows, internal rate of return, fixed and flexible budget, and behavioral aspect of budgeting. On behavioral aspect of budgeting, there are numerous interrelationships between types of budget, budgeting process, and the motivation of employees. There are top-down budgets, bottom-up budgets, unrealistic budget. For top-down budgets may be necessary from a coordination point of view. However, they can be demotivating to employees. For bottom-up budgets, allow useful employee input, but they may create exaggerated expectation on the part of the employee that his voice will be heard. An unrealistic budget with unachievable targets can be demotivating, as can budgets which are easily achieved since most people stop working when they reach the target. The next, I will explain fourth point. The fourth point is standard costing. On standard costing, there is absorption costing. Absorption costing is method urges that focusing on marginal costing is potentially misleading in the longer run because fixed production costs have also to be covered. Accounting convention require that fixed production costs be reflected in each unit product. The next is cost card, but I will not to explain that. There are basic variance analysis. Next is interpreting variances. On interpreting variances, there are material price, material usage, labor rate, labor efficiency, overhead expenditure, overhead volume. On interpreting variances, as can be seen above, a factor causing a favorable variance may, at the same time, be the cause of an adverse variance in another part of the company operation. It is management's responsibility to understand these relationships and to be able to anticipate and, if possible, quantify the impact of their actions on overall performance. At the same time, management needs to review standards for their relevance and usefulness as well as apply common sense to the materiality and controllability of specific variances. The next in reconciliation of budget profit and actual profit. Next, okay. Last point is performance measurement. Okay, the first mission statement, it sets the broad purpose of the organization. It is articulated in a mission statement, which is in an open-ended statement outlining the core value of the business, defining the industry the firm competes in, and describing the general way of doing business. Financial performance measures include in financial performance measure is a range of ratio, efficiency ratio, gearing ratio, liquidity ratio, profitability ratio, and interest ratio. The next, value for money. A useful way to judge performance in a not-for-profit organization is to apply the value for money method can be useful. It incorporates three elements, referred to as the three is economy, efficiency, and effectiveness. The next, the scope of performance measurement. There is balance scorecard. The balance scorecard addresses a number of parameters or perspectives in monitoring business performance by asking the following question: Is financial perspective an example for financial perspective? To success financially, how should we appear to our shareholder? For customer perspective, the example, to achieve our vision, how should we appear to our customers? For internal business process, the example, to satisfy our shareholders and customer, what business process must we excel at? And for learning and growth, the example, to achieve our vision, how will we sustain our ability to change and improve? Yeah, uh, that is some example perspective from some for some example. Okay, the next is residual income, non-financial performance indicator. Um, on non-financial performance indicator are important because the first, they broaden management's view of what needs to be mastered and measured in the organization. If financial measures alone were used, there is the risk of focusing only on improving financial results in the short term while neglecting the long term viability of the business. The next employees, especially at the operational level, can relate more easily to NFPIs, and less companies increasingly resort to NFPIs since operational measure may provide a leading or early indicator of what becomes visible only later in the financial result. In other words, management can react more quickly to problems. Okay, guys, that are my presentation about management accounting for the first assignment at management accounting. Thank you very much for attention. See you for the next assignment. Bye bye.